Again, it's time for prophecy to be fulfilled. And it's also time for the Shmita. It's said that on Wall Street, a cure is proving to be nearly as bad as the disease. Investment strategies that promise to insulate investors from risk are being seen as actually having contributed to the wild market swings in recent weeks. That seemingly upside-down outcome follows an explosion in investments aimed at avoiding pratfalls in the market, as opposed to making direct bets on a company, asset class, or theme, and has become an investment rage in recent years. Their popularity boomed after global central banks pumped trillions of dollars into asset markets in a bid to spur economic growth. Now, however, some experts warn that the sums that flowed into so-called risk parity funds and exchange-traded funds, or E.T.F.s, over the last 5 years have become so large that the end result has been a riskier, more volatile market. Analysts estimate that there is currently around $4 trillion tied up in these investment strategies. The fear is that as the returns continue to suffer, a wave of investor selling will start a wider market rout as managers struggle to unload high-yield, high-return bonds and equities alike. The professional investment community is very worried about this, said Julian Brigden of Macro Intelligence 2 Partners, an independent research firm based in Vail, Colorado, that advises large money management firms on global investment themes. He contends that this latest flurry of sophisticated investment vehicles produced by Wall Street has created a false impression of robust investment returns with minimal downside risks. It's this constant striving by the street to keep investors happy, so you keep seeing these leveraged risk parity funds and power E.T.F.s. Risk parity funds, for example, have used leverage to reduce the exposure that portfolios have to stocks, which tend to be more volatile investments, by loading up on emerging market and high-yield bonds. The idea is to give investors equity-like returns without the volatility and concentration risk that comes from making a big bet on stocks. Then there are exchange-traded funds, investment vehicles that track an index linked to an investment style, stocks, bonds, or commodities, to name a few, but trade on exchanges and promise the investor instant liquidity and transparency. Trading in E.T.F.s now accounts for close to 20% of total volume for stocks in the United States, while many investors in some of the larger funds, like the $169 billion SPDR fund, which tracks the Standard & Poor's 500 stock index, are in it for the long term. There is a lot of short-term oriented buying and selling that goes on within the fund. At a time when global liquidity has been ample, piling into an E.T.F., investing in leveraged loans, or into the $80 billion risk parity hedge fund of Bridgewater Associates has paid dividends for investors. Over the last month or so, however, China's decision to let its currency weaken has set off a new wave of market turmoil. Bonds that were supposed to provide stability to investor portfolios have declined in value along with stocks. Making matters worse is that central banks in China and other Asian countries, which for years have been large buyers of United States Treasury securities, have started to sell out of these positions to defend their weakening currencies, with many of these bonds becoming core holdings in E.T.F. and risk parity portfolios. The downward pressure on markets has been amplified. In other words, it's messed things up. Some of the more exotic E.T.F.s that rely on leverage to juice investment returns could, in some instances, be the tail that wags the dog, said an early pioneer in ETF investing and founder of Blue Star Global Investors. But the fundamental advantage of ETFs, transparency, liquidity, and variety, that remains. So they say. What remains unclear, however, is how an investing community that has become accustomed to churning out safe and steady returns in a low interest rate, low volatility environment adapts to the new reality of wild market swings. Such sharp ups and downs in the market are expected to become more frequent as the time approaches for the Federal Reserve to push interest rates higher, which could also push the market lower. People might as well get used to them. In other words, there could be more volatility ahead, and these types of sudden market swings will become more and more frequent, so you have to be prepared for them at any time. To survive such bouts of volatility, again, or so they say. On a broader scale, though, Mr. Brigden, the investment advisor, thinks that the shakeout of the last month will continue as investors come to realize that the days of low volatility investing are over. We have had this long backdrop of suppressed volatility, with equities doing well and an utter lack of bond risk, he said, with central banks no longer buying bonds. That virtuous cycle is becoming vicious. It's time for the Shmita. And this, too, is another end of times as we know them, transition days, which is a time of extraordinary changes, happenings, and events, because it's about what kind of world are we leaving to the future generations, and that should be a very important question to ask. Jeremiah chapter 8, verse 13. I will surely consume them, saith the Lord. There shall be no grapes on the vine, nor figs on the fig tree, and the leaf shall fade, and the things that I have given them shall pass away from them. 14. Why do we sit still? Assemble yourselves, and let us enter into the defense cities, and let us be silent there. For the Lord our God has put us to silence, and given us water of gall to drink, because we have sinned against the Lord. 15. We looked for peace, but no good came, and for a time of health, and behold, trouble. Yes, it's time for prophecy to be fulfilled, and all these are more signs. It's also time for the Shmita, and it is a process